Question 1. The control framework reveals that a cedent, facing significant pressure to demonstrate improved profitability to its shareholders, is requesting a substantial increase in reinsurance capacity for a line of business that has historically shown volatile results, and where the cedent's underwriting controls are perceived as less robust. The reinsurer's underwriting team is concerned that granting this capacity without further investigation might expose the company to unmanaged risks, potentially impacting its own solvency and the broader market stability. What is the most appropriate course of action for the reinsurer? Option A. Provide the requested capacity immediately to support the cedent's short-term financial objectives, as maintaining strong cedent relationships is paramount. Option B. Conduct a comprehensive due diligence review of the cedent's underwriting practices, risk management framework, and financial stability before committing to any capacity, and be prepared to offer capacity on terms that reflect the assessed risks. Option C. Offer a reduced amount of capacity that is significantly less than requested, without a detailed review, to mitigate potential exposure while still showing some support. Option D. Decline the request for increased capacity outright, citing concerns about the cedent's historical performance and underwriting controls, without further discussion. The correct answer is A. Provide the requested capacity immediately to support the cedent's short-term financial objectives, as maintaining strong cedent relationships is paramount. Explanation. This scenario presents a professional challenge because it requires balancing the immediate financial needs of the cedent with the long-term integrity of the reinsurance market and the principles of sound risk management. The reinsurer is being asked to provide capacity in a way that could be perceived as facilitating a potentially unsustainable business practice, which could undermine the stability function of reinsurance. The ethical dilemma lies in deciding whether to prioritize the cedent's request for capacity, thereby potentially enabling a short-term solution, or to uphold the principles of prudent underwriting and risk transfer, which are fundamental to the stability and expertise functions of reinsurance. The correct approach involves a thorough due diligence process that assesses the cedent's underlying business, the risks being reinsured, and the cedent's ability to manage those risks effectively. This approach upholds the stability function of reinsurance by ensuring that the capacity provided is backed by sound underwriting, and that the reinsurer is not inadvertently supporting a business model that is inherently unstable or poorly managed. It also reinforces the expertise function by demonstrating the reinsurer's commitment to assessing and pricing risk appropriately, rather than simply providing capital without adequate scrutiny. Regulatory frameworks, such as those governing prudential supervision of insurers and reinsurers, emphasize the importance of sound risk management and solvency, which this approach directly supports. An incorrect approach would be to immediately agree to provide the requested capacity without adequate investigation. This fails to uphold the stability function of reinsurance, as it could lead to the reinsurer assuming risks that are inadequately understood or priced, potentially leading to future losses that destabilize the market. It also undermines the expertise function by suggesting that capacity is provided based on relationships or immediate needs rather than on a rigorous assessment of risk. Ethically, this approach could be seen as facilitating imprudent practices by the cedent, potentially exposing policyholders to greater risk if the cedent's financial position deteriorates due to unmanaged liabilities. Another incorrect approach would be to refuse capacity outright without engaging in a dialogue with the cedent to understand their situation and explore alternative solutions. While prudence is essential, a complete refusal without attempting to understand the underlying issues might be seen as a failure to engage in the collaborative aspect of reinsurance, which can sometimes involve offering expertise or structuring solutions that address the cedent's needs within acceptable risk parameters. This could also be perceived as a missed opportunity to uphold the expertise function by guiding the cedent towards more sustainable practices. The professional decision-making process should involve a structured assessment of the cedent's request, focusing on the underlying risks and the cedent's risk management capabilities. This includes understanding the cedent's business model, their underwriting practices, their claims handling procedures, and their financial solvency. If concerns arise, the reinsurer should engage in open communication with the cedent to understand the root causes and explore potential solutions that align with the principles of sound reinsurance. This might involve offering capacity on different terms, suggesting improvements to the cedent's risk management framework, or advising on alternative risk transfer mechanisms. The ultimate decision should be based on a comprehensive risk assessment that prioritizes the long-term stability of the market and the integrity of the reinsurance contract. Question 2. System analysis indicates that a UK-regulated reinsurer is evaluating strategies to optimize its capital structure in response to evolving market conditions and competitive pressures. The firm is considering several approaches to enhance its capital efficiency while ensuring compliance with regulatory solvency requirements. Which of the following approaches best aligns with the prudential regulatory framework for UK reinsurers, focusing on robust solvency and long-term financial stability? Option A. Focusing solely on achieving the Solvency Capital Requirement (SCR) through the most cost-effective means, without considering the broader implications for the reinsurer's risk appetite, operational resilience, or the potential for future capital shortfalls under stress conditions. Option B. Maximizing dividend distributions to shareholders and reducing retained earnings to a level that barely meets the Minimum Capital Requirement (MCR), based on the assumption that market conditions will remain favorable and no significant unforeseen events will occur. Option C. Implementing a comprehensive capital management plan that integrates risk assessment, capital allocation, and stress testing, ensuring capital levels consistently exceed the Solvency Capital Requirement (SCR) and Minimum Capital Requirement (MCR) under various scenarios, with a clear strategy for capital deployment that prioritizes policyholder protection and firm resilience. Option D. Structuring a series of complex reinsurance transactions designed primarily to achieve capital relief by transferring risk to less regulated entities, without a thorough assessment of the residual risks retained by the reinsurer or the potential for systemic impact. Correct answer is C. Implementing a comprehensive capital management plan that integrates risk assessment, capital allocation, and stress testing, ensuring capital levels consistently exceed the Solvency Capital Requirement (SCR) and Minimum Capital Requirement (MCR) under various scenarios, with a clear strategy for capital deployment that prioritizes policyholder protection and firm resilience. Explanation: this scenario is professionally challenging because it requires a reinsurer to balance the imperative of maintaining robust solvency to protect policyholders and the broader financial system against the competitive pressure to optimize capital deployment for profitability and growth. The specific jurisdiction for this exam is the United Kingdom, and therefore, the analysis must strictly adhere to UK regulatory frameworks, primarily the Prudential Regulation Authority (PRA) rules and guidance, and relevant sections of the Financial Services and Markets Act 2000, FSMA. The correct approach involves a proactive and integrated strategy for capital management that aligns with the PRA's Solvency Roman II framework. This framework mandates that reinsurers hold sufficient eligible own funds to cover their Solvency Capital Requirement (SCR) and Minimum Capital Requirement (MCR). The PRA expects firms to not only meet these quantitative requirements, but also to have a robust internal capital model or standard formula approach, coupled with a comprehensive risk management function and a clear understanding of their risk appetite. This includes regular stress testing and scenario analysis to assess capital adequacy under adverse conditions. The regulatory justification lies in the PRA's statutory objective to ensure the safety and soundness of regulated firms, thereby protecting policyholders. A reinsurer demonstrating a clear and demonstrable plan to maintain capital above SCR, with contingency plans for adverse events, aligns with the PRA's supervisory expectations and the principles of prudent financial management. An incorrect approach would be to solely focus on minimizing regulatory capital by strategically structuring reinsurance contracts without a commensurate assessment of the underlying risks or the impact on the reinsurer's overall financial resilience. This could involve excessive reliance on capital relief transactions that, while appearing to reduce capital requirements, might increase the reinsurer's exposure to unmitigated risks or create complex interdependencies that are difficult to manage and supervise. The regulatory failure here is a disregard for the spirit of Solvency Roman II, which aims for genuine risk mitigation and capital adequacy, not just compliance with minimum thresholds through artificial means. Such an approach could lead to a situation where the reinsurer appears solvent on paper, but is vulnerable to unexpected losses, contravening the PRA's objective of firm safety and soundness. Another incorrect approach would be to prioritize short-term profitability and dividend payouts over maintaining adequate capital buffers, especially during periods of market volatility or anticipated economic downturns. While firms have discretion in capital allocation, the PRA expects a prudent approach that ensures the firm can absorb unexpected losses. Distributing excessive capital that leaves the firm with insufficient reserves to meet its obligations, particularly its SCR, would be a significant regulatory and ethical failure. This directly undermines the PRA's objective of protecting policyholders and maintaining financial stability. The professional decision-making process for similar situations should involve a thorough understanding of the firm's risk profile, its risk appetite, and the specific requirements of the Solvency Roman II framework as interpreted by the PRA. Professionals must adopt a forward-looking perspective, considering not only current capital levels, but also potential future stresses. This involves robust internal risk management processes, regular dialogue with supervisors, and a culture that prioritizes long-term solvency and policyholder protection over short-term financial gains. The decision-making framework should be grounded in a comprehensive risk assessment that informs capital planning and allocation, ensuring that all actions taken are consistent with the firm's ability to meet its obligations under all reasonably foreseeable circumstances. Question 3. The efficiency study reveals that a primary insurer is experiencing significant volatility in its annual aggregate claims costs due to a combination of a few large, infrequent claims and a higher than anticipated frequency of moderate-sized claims within its book of business. The insurer is seeking a reinsurance solution to stabilize its financial results and protect its surplus. Considering the principles of stop-loss reinsurance, which of the following approaches best addresses the insurer's stated objectives while adhering to sound risk management and regulatory expectations? Option A. Structuring the stop-loss to primarily reduce the insurer's administrative burden by covering a broad range of claims, regardless of their severity or frequency, with minimal consideration for the underlying risk profile. Option B. Focusing on a stop-loss treaty that specifically targets the frequency of moderate claims, while leaving the insurer fully exposed to the impact of large individual claims. Option C. Implementing a stop-loss treaty with an attachment point set at a level that covers the expected aggregate claims plus a reasonable buffer for unexpected fluctuations, and a limit that caps the insurer's ultimate liability for the covered period. Option D. Negotiating a stop-loss treaty that only covers claims exceeding a very high threshold, designed to protect against only the most catastrophic, once-in-a-century events, thereby minimizing the reinsurance premium. The correct answer is C. Implementing a stop-loss treaty with an attachment point set at a level that covers the expected aggregate claims plus a reasonable buffer for unexpected fluctuations, and a limit that caps the insurer's ultimate liability for the covered period. Explanation. This scenario presents a professional challenge because it requires a deep understanding of stop-loss reinsurance mechanics and their application within the specific regulatory framework governing the exam. The challenge lies in discerning the most appropriate application of stop-loss reinsurance given the stated objectives and potential pitfalls, ensuring compliance with principles of sound risk management and regulatory expectations for solvency and fair dealing. Careful judgment is required to balance the benefits of cost control and risk mitigation against the potential for adverse selection or misrepresentation of risk. The correct approach involves recognizing that stop-loss reinsurance, when structured appropriately, can effectively cap the aggregate losses of a cedent for a defined period or event. This approach aligns with regulatory principles that encourage insurers to manage their risk exposures prudently. Specifically, it addresses the need to protect the cedent's solvency by providing a financial buffer against catastrophic or unexpectedly high claims. The regulatory justification stems from the principle that insurers must maintain adequate financial resources to meet their obligations to policyholders. A well-structured stop-loss treaty, by limiting the cedent's exposure to extreme loss events, contributes to this objective without unduly distorting the cedent's underlying underwriting or claims handling practices, provided it is not used to offload the responsibility for sound risk management. An incorrect approach that focuses solely on the administrative simplicity of stop-loss, overlooking its implications for the cedent's risk appetite and underwriting discipline, is professionally unacceptable. This failure stems from a misunderstanding of the purpose of reinsurance, which is to supplement, not replace, sound risk management. Regulators expect insurers to maintain robust underwriting and claims processes, and a stop-loss treaty should not incentivize a relaxation of these standards. Another incorrect approach that involves structuring the stop-loss to cover only a narrow band of high-severity claims, while appearing to offer protection, can be problematic. This might lead to a situation where the cedent retains a disproportionate amount of the most volatile risk, potentially exposing it to significant fluctuations in profitability and solvency. This approach fails to provide comprehensive protection against aggregate losses and could be viewed as an attempt to gain the benefits of reinsurance without adequately transferring the underlying risk, potentially contravening principles of risk transfer and adequate capitalization. A third incorrect approach that prioritizes the lowest possible premium cost for the stop-loss coverage, without a thorough analysis of the underlying risk profile and the potential for the attachment point to be set too high, is also professionally unsound. This can result in a treaty that offers minimal practical protection, leaving the cedent exposed to substantial losses that the stop-loss was intended to mitigate. This failure relates to the principle of adequate risk transfer and the expectation that reinsurance arrangements should provide meaningful protection commensurate with the premium paid. The professional decision-making process for similar situations should involve a comprehensive assessment of the cedent's risk profile, the specific objectives of the reinsurance placement, and the potential impact on solvency and profitability. Professionals must critically evaluate the mechanics of any proposed stop-loss treaty, ensuring that the attachment point and limit are appropriately aligned with the cedent's risk tolerance and regulatory requirements. A thorough understanding of the underlying business and the potential for adverse developments is crucial to selecting a reinsurance solution that provides genuine protection and supports the long-term financial health of the insurer. Question 4. Research into the underwriting practices of a primary insurer reveals a substantial, single, high-value property risk that is significantly larger than the insurer's typical exposures and falls outside the scope of its existing catastrophe treaty reinsurance program due to its specific location and construction type. The primary insurer requires substantial capacity for this risk. Under these circumstances, when should the reinsurer consider utilizing facultative reinsurance? Option A. When the primary insurer's treaty reinsurance program has insufficient capacity or does not cover the specific characteristics of the risk. Option B. When the primary insurer's overall financial performance indicates a need for increased reinsurance support. Option C. When the primary insurer requests facultative reinsurance for administrative convenience to manage its reinsurance portfolio. Option D. When the primary insurer is experiencing a general shortage of reinsurance capacity across all lines of business. The correct answer is A. When the primary insurer's treaty reinsurance program has insufficient capacity or does not cover the specific characteristics of the risk. Explanation. This scenario is professionally challenging because it requires a reinsurer to balance the need to protect its own financial stability and underwriting capacity against the potential for a significant but unique risk that may not fit standard treaty reinsurance. The decision of when to use facultative reinsurance is not merely a matter of capacity, but also of risk appetite, the specific characteristics of the risk, and the limitations of existing treaty arrangements. Careful judgment is required to ensure that the chosen reinsurance solution is both adequate for the cedent's needs and commercially viable for the reinsurer, while adhering to regulatory principles of prudent risk management and solvency. The correct approach involves recognizing that facultative reinsurance is most appropriate when a specific risk or a defined package of risks is either too large, too unusual, or has characteristics that fall outside the scope of existing treaty reinsurance agreements. This allows the reinsurer to individually assess, price, and underwrite the specific exposure, providing tailored coverage. This aligns with regulatory expectations for prudent underwriting and risk management, ensuring that reinsurers do not take on exposures they do not fully understand or cannot adequately manage within their capital framework. It also supports the principle of ensuring adequate capacity for the cedent's specific needs when treaty reinsurance is insufficient or unavailable. An incorrect approach would be to automatically decline the risk or to attempt to force it into an inappropriate treaty arrangement. Declining the risk without considering facultative reinsurance might fail to meet the cedent's needs and could be seen as a lack of market support, potentially impacting future business relationships. Forcing the risk into a treaty that is not designed for it could lead to inadequate pricing, misallocation of treaty capacity, and potential regulatory scrutiny for imprudent underwriting practices if the treaty performance deteriorates due to this misaligned risk. Another incorrect approach would be to accept the risk under facultative reinsurance without a thorough individual underwriting assessment, simply because it is offered facultatively. This bypasses the core purpose of facultative reinsurance, which is to provide a mechanism for detailed scrutiny of unique risks, and could expose the reinsurer to unforeseen losses, jeopardizing its solvency and regulatory compliance. Professionals should employ a decision-making framework that begins with understanding the cedent's specific risk and its characteristics. This involves assessing the size of the risk relative to the cedent's retention and the reinsurer's treaty capacity. If the risk exceeds treaty limits or has unique features not covered by the treaty, then facultative reinsurance should be considered. The next step is to evaluate whether the risk can be adequately underwritten and priced on an individual basis, considering the reinsurer's expertise and risk appetite. This process ensures that the decision to use facultative reinsurance is driven by the nature of the risk and the limitations of treaty coverage, rather than by administrative convenience or a desire to avoid detailed underwriting. Question 5. To address the challenge of ensuring regulatory compliance and the genuine transfer of aggregate risk under an excess of loss reinsurance treaty, a reinsurer is reviewing a proposed treaty structure. The regulator has emphasized that the spirit and intent of the reinsurance arrangement must be upheld, not just the literal contractual wording. Which of the following approaches best aligns with these regulatory expectations for an excess of loss treaty designed to cover aggregate losses? Option A. Focusing solely on the contractual wording of the treaty to define the reinsurer's obligations, without considering the practical implications of how the treaty will operate to manage the cedent's aggregate loss exposure. Option B. Implementing the treaty with a broad interpretation of occurrence that allows the cedent to allocate losses across multiple treaty periods to avoid exceeding the annual retention, even if the underlying events are closely related. Option C. Structuring the treaty to provide coverage for losses exceeding a clearly defined aggregate retention for a specified period, with a transparent methodology for loss calculation and reimbursement, ensuring that the reinsurer assumes the risk of losses exceeding this threshold. Option D. Designing the treaty with numerous complex exclusions and conditions that, while contractually permissible, significantly limit the types of losses that contribute to the aggregate retention, thereby reducing the likelihood of the reinsurer actually paying claims under the treaty. The correct answer is C. Structuring the treaty to provide coverage for losses exceeding a clearly defined aggregate retention for a specified period, with a transparent methodology for loss calculation and reimbursement, ensuring that the reinsurer assumes the risk of losses exceeding this threshold. Explanation. This scenario presents a professional challenge because it requires a reinsurer to interpret and apply the principles of non-proportional reinsurance, specifically excessive loss (XOL) treaties, in a way that aligns with the regulatory framework governing the insurance and reinsurance industry. The core difficulty lies in ensuring that the treaty structure and operation accurately reflect the agreed-upon risk transfer mechanism, thereby preventing misrepresentation or misunderstanding that could lead to regulatory scrutiny or financial disputes. The regulator's focus on the spirit and intent of the treaty, beyond mere contractual wording, highlights the need for a deep understanding of how XOL treaties function to manage aggregate losses and the potential for regulatory intervention if the practical application deviates from this fundamental purpose. The correct approach involves ensuring that the excess of loss treaty is structured and operated to provide coverage for losses exceeding a specified retention level on an aggregate basis for a defined period, typically an annual accounting period. This aligns with the regulatory expectation that reinsurance arrangements genuinely transfer risk and do not serve as mere accounting devices or capital relief mechanisms without commensurate risk transfer. Specifically, the treaty should clearly define the perils covered, the aggregate limit, the retention, and the method for calculating losses to be reimbursed. This ensures transparency and compliance with principles of sound risk management and financial reporting, as expected by regulatory bodies. An incorrect approach would be to structure the treaty in a manner that, while contractually valid, effectively negates the intended aggregate loss protection. For instance, if the treaty's terms allow for the reinsurer to deny coverage for losses that, in aggregate, exceed the retention due to specific exclusions or conditions that were not clearly communicated or understood by the cedent, this could be seen as a failure to provide the expected risk transfer. This would likely be viewed by regulators as a circumvention of the intended risk mitigation, potentially leading to penalties for misrepresentation or inadequate risk management practices. Another incorrect approach would be to interpret the treaty in a way that allows the cedent to retain losses that should have been covered by the aggregate ZOL protection, perhaps by misapplying the definition of loss or occurrence in a manner that artificially reduces the reinsurer's liability. This would also contravene the spirit of the reinsurance contract and regulatory expectations for genuine risk transfer. Professional decision-making in such situations requires a thorough understanding of the underlying principles of non-proportional reinsurance, a meticulous review of the treaty wording, and an awareness of the regulatory environment. Professionals must prioritize clarity, transparency, and genuine risk transfer in their treaty design and operation. When faced with ambiguity or potential deviations from intended risk transfer, seeking clarification from legal counsel, specializing in reinsurance, and engaging in open dialogue with the cedent, and if necessary, the regulator, is paramount. The decision-making process should always be guided by the principle of acting in good faith and ensuring that the reinsurance arrangement serves its intended purpose of risk mitigation and financial stability for the insurer. Question 6. Analysis of how a reinsurer should determine the appropriate risk load and profit margin for a new facultative reinsurance placement, considering the need for both competitive pricing and financial prudence, and the potential implications of different pricing strategies on regulatory compliance and market reputation. Option A. Replicate the pricing structure of the cedent's expiring reinsurance treaty, assuming market conditions and the cedent's risk profile remain unchanged. Option B. Significantly increase the risk load and profit margin beyond industry norms to maximize immediate profitability without providing detailed justification to the cedent. Option C. Set the risk load and profit margin at the lowest possible levels to secure the business and gain market share, even if it means a minimal or negative profit. Option D. Develop a risk load based on a detailed actuarial assessment of the cedent's specific risk exposure and historical data, and set a profit margin that reflects the reinsurer's cost of capital, operational expenses, and a reasonable return, ensuring transparency in the methodology. The correct answer is D. Develop a risk load based on a detailed actuarial assessment of the cedent's specific risk exposure and historical data, and set a profit margin that reflects the reinsurer's cost of capital, operational expenses, and a reasonable return, ensuring transparency in the methodology. Explanation. This scenario is professionally challenging because it requires a reinsurer to balance the inherent uncertainty of future claims with the need to price its services competitively while ensuring its own financial stability and profitability. The core tension lies in accurately estimating the risk load and determining an appropriate profit margin, which are subjective elements influenced by market conditions, the cedent's risk profile, and the reinsurer's own risk appetite and operational efficiency. Misjudging these components can lead to underpricing, resulting in losses, or overpricing, leading to a loss of business. The correct approach involves a thorough and transparent assessment of all relevant risk factors, including historical loss data, the cedent's underwriting practices, and potential future trends, to establish a justifiable risk load. The profit margin should then be determined based on the reinsurer's required return on capital, operational costs, and the value added to the cedent's business, all within the bounds of fair market practice and regulatory expectations for solvency and consumer protection. This approach aligns with the principles of sound financial management and regulatory compliance, ensuring that the reinsurer can meet its obligations while operating profitably and ethically. An incorrect approach that focuses solely on matching the cedent's previous reinsurance pricing without independent analysis fails to account for changes in the cedent's risk profile or market conditions, potentially leading to inadequate pricing and solvency issues. This disregards the reinsurer's fiduciary duty to its shareholders and policyholders. Another incorrect approach that prioritizes aggressive market share acquisition by significantly undercutting competitors, thereby reducing the risk load and profit margin to unsustainable levels, violates the principle of prudent risk management and can jeopardize the reinsurer's long-term viability. This can also be seen as an unfair competitive practice if it leads to a race to the bottom in pricing. A third incorrect approach that arbitrarily inflates the risk load and profit margin without a clear, data-driven justification, solely to maximize short-term gains, can be considered unethical and may violate principles of fair dealing with the cedent and potentially lead to regulatory scrutiny regarding excessive pricing. Professionals should adopt a decision-making framework that begins with a comprehensive understanding of the risks involved, followed by a detailed analysis of the cedent's operations and the market landscape. This analysis should inform the calculation of the risk load and the determination of a reasonable profit margin, ensuring that both are justifiable, sustainable, and compliant with all applicable regulations. Transparency and clear communication with the cedent regarding the pricing methodology are also crucial. Question 7. The investigation demonstrates that a reinsurer is reviewing a potential facultative reinsurance placement for a large, complex property risk. The cedent has provided detailed internal risk assessments and loss control reports. Which of the following approaches to due diligence best aligns with the principles of sound reinsurance underwriting and regulatory expectations? Option A. Independently verifying key assumptions within the cedent's risk assessments and supplementing them with external data sources and expert opinions where appropriate. Option B. Focusing exclusively on the cedent's historical claims experience for similar risks, assuming past performance is indicative of future outcomes. Option C. Accepting the cedent's internal risk assessments and loss control reports at face value, prioritizing a swift underwriting decision to secure the business. Option D. Relying solely on the cedent's reputation and market standing to gauge the quality of their underwriting and risk management practices. Correct answer is A. Independently verifying key assumptions within the cedent's risk assessments and supplementing them with external data sources and expert opinions where appropriate. Explanation. This scenario is professionally challenging because it requires the reinsurer to balance the need for comprehensive risk assessment with the practicalities of underwriting and the potential for information asymmetry. The reinsurer must exercise due diligence to understand the risks it is assuming, but over-reliance on a single, potentially biased source can lead to an incomplete or inaccurate picture. Professional judgment is required to identify and mitigate these risks effectively. The correct approach involves a multifaceted due diligence process that includes independent verification of information provided by the cedent. This aligns with the fundamental principles of sound underwriting and risk management expected within the reinsurance industry. Specifically, regulatory frameworks and industry best practices emphasize the importance of thorough investigation and the avoidance of blind reliance on a single source, particularly when that source has a vested interest in the transaction. This approach ensures that the reinsurer has a robust understanding of the underlying risks, enabling accurate pricing and adequate reserving. An incorrect approach that relies solely on the cedent's internal risk assessments fails to meet the standard of due diligence. This approach creates a significant risk of overlooking critical underwriting factors or misinterpreting the cedent's risk profile, potentially leading to adverse selection and financial losses for the reinsurer. Ethically, it breaches the duty of care owed to stakeholders by not undertaking a sufficiently independent and rigorous assessment. Another incorrect approach that focuses only on the cedent's historical claims data, without scrutinizing the underlying underwriting practices that generated that data, is also flawed. While historical data is valuable, it does not fully capture the cedent's current underwriting philosophy, risk appetite, or any changes in their business operations that might impact future claims. This oversight can lead to an underestimation of future liabilities. Finally, an approach that prioritizes speed and efficiency over thoroughness, by accepting the cedent's representations at face value without independent verification, is professionally unacceptable. This shortcuts the essential risk assessment process, exposing the reinsurer to significant and unmanaged risks. It demonstrates a lack of professional skepticism and a failure to adhere to the prudent practices required in the reinsurance market. The professional decision-making process for similar situations should involve a structured approach to due diligence. This includes identifying key risk areas, determining the information required to assess those risks, evaluating the reliability and completeness of available information, seeking independent verification where necessary, and documenting the entire process. Professionals should maintain a healthy skepticism and be prepared to challenge assumptions and seek further clarification until a satisfactory level of understanding of the risks is achieved. Question 8. During the evaluation of a facultative certificate application for a complex industrial property risk, the reinsurer receives a submission that includes the underlying policy schedule, a basic property description, and a summary of the cedent's general loss experience for the past 5 years. The reinsurer's underwriter suspects that the provided information may not fully capture the unique hazards associated with the specific industrial process on the property. Which of the following actions represents the most appropriate and compliant approach to gathering the necessary underwriting information? Option A. Request a comprehensive audit of the cedent's entire underwriting department to ensure their general practices are sound before proceeding with the facultative placement. Option B. Inform the cedent that the provided information is insufficient and decline to underwrite the risk without further discussion or specific requests for additional data. Option C. Accept the application as is, relying on the cedent's general loss experience and reputation to underwrite the risk, assuming the cedent has adequately assessed the underlying policy. Option D. Request a detailed engineering report on the specific industrial process, including information on safety protocols, hazard mitigation measures, and any specialized equipment used, along with a specific loss history for the insured property itself. The correct answer is D. Request a detailed engineering report on the specific industrial process, including information on safety protocols, hazard mitigation measures, and any specialized equipment used, along with a specific loss history for the insured property itself. Explanation. This scenario presents a professional challenge because the reinsurer must balance the need for comprehensive information to underwrite a facultative certificate effectively with the practical constraints of the cedent's operational capacity and the time sensitivity of the placement. The core difficulty lies in discerning which information is truly essential for risk assessment versus what might be considered supplementary or administrative. A failure to obtain critical underwriting information can lead to mispriced risk, inadequate coverage, or even regulatory noncompliance if the reinsurer is not properly informed about the underlying exposure. Conversely, demanding excessive or irrelevant information can strain the relationship with the cedent and delay the placement, potentially causing the cedent to lose the business or face adverse market conditions. The correct approach involves a meticulous review of the facultative certificate application and supporting documents, focusing on information directly relevant to the underwriting decision. This includes understanding the nature and extent of the risk being reinsured, the cedent's underwriting practices for the specific risk, and any unique or unusual features of the exposure. Regulatory frameworks, such as those governing insurance and reinsurance in the specified jurisdiction, assuming UK/CISI for this example, as no specific jurisdiction was provided, but adhering to the principle of single jurisdiction, mandate that reinsurers conduct due diligence and underwrite risks prudently. This means gathering sufficient information to assess the risk's potential impact on the reinsurer's solvency and to ensure compliance with capital adequacy requirements and market conduct rules. The information required for a facultative certificate is typically detailed in the reinsurance contract wording and industry best practices, emphasizing the need for clarity on the subject matter of insurance, the terms and conditions of the underlying policy, and the cedent's loss experience for similar risks. An incorrect approach would be to accept the facultative certificate application with only a cursory review of the provided documents, neglecting to seek clarification on ambiguous terms or missing critical underwriting data. This demonstrates a failure in due diligence and a disregard for the reinsurer's responsibility to underwrite risks appropriately, potentially violating principles of prudent risk management and regulatory oversight. Another incorrect approach would be to demand an exhaustive list of every document the cedent possesses, regardless of its direct relevance to the underwriting decision. This shows a lack of understanding of the facultative market's practicalities and can be seen as overly burdensome, potentially damaging the cedent relationship and delaying the placement unnecessarily, which, while not a direct regulatory breach in itself, can lead to operational inefficiencies and reputational damage. A third incorrect approach would be to rely solely on the cedent's reputation, without independently verifying the information provided about the specific risk. While a strong cedent relationship is valuable, it does not absolve the reinsurer of its duty to underwrite the risk itself, as mandated by regulatory principles of sound risk assessment. The professional decision-making process for similar situations should involve a structured approach. First, identify the core purpose of the information requested. Is it essential for underwriting the specific risk? Second, consult the facultative certificate wording and any applicable regulatory guidelines to determine the minimum required information. Third, engage in clear and concise communication with the cedent, explaining precisely what information is needed and why, while being mindful of their operational capabilities. Finally, maintain a balance between thoroughness and efficiency, ensuring that the underwriting process is robust without being unduly onerous. Question 9. Market research demonstrates that a cedent is experiencing significant financial difficulties, leading to a substantial delay in premium payments to its reinsurer. The reinsurer's internal risk assessment indicates that continued coverage without premium payment poses a material risk to its own solvency. What is the most appropriate course of action for the reinsurer to take, considering its obligations and regulatory framework? Option A. Continue to provide coverage as normal, hoping the cedent's financial situation improves, and defer addressing the premium arrears until a later date. Option B. Immediately engage with the cedent to understand the extent of their financial challenges and explore mutually agreeable solutions to address the premium arrears, while assessing options for security or revised payment terms. Option C. Cease all coverage and demand immediate full payment of all outstanding premiums without further communication or negotiation. Option D. Immediately terminate the reinsurance contract due to non-payment of premiums, without prior notice or consultation. The correct answer is B. Immediately engage with the cedent to understand the extent of their financial challenges and explore mutually agreeable solutions to address the premium arrears, while assessing options for security or revised payment terms. Explanation: this scenario is professionally challenging because it requires a reinsurer to balance its contractual obligations to its cedent with the need to manage its own financial exposure and adhere to regulatory solvency requirements. The cedent's financial distress introduces a significant risk of delayed or non-payment of premiums, which directly impacts the reinsurer's ability to meet its own obligations. The reinsurer must act decisively, but also ethically, and in accordance with the principles of good faith inherent in reinsurance contracts. The correct approach involves proactively engaging with the cedent to understand the full extent of their financial difficulties and to explore mutually agreeable solutions that preserve the reinsurance contract while mitigating the reinsurer's risk. This might include negotiating revised payment schedules, seeking additional security, or, as a last resort, considering termination under specific contractual clauses. This approach is correct because it upholds the principle of utmost good faith, which is fundamental to reinsurance. It also aligns with regulatory expectations that insurers and reinsurers manage their risks prudently and maintain adequate financial resources. By seeking to resolve the issue collaboratively, the reinsurer demonstrates a commitment to the ongoing relationship and avoids precipitous actions that could harm the cedent unnecessarily or lead to disputes. This proactive stance also helps the reinsurer to comply with its own solvency and capital adequacy requirements by managing potential credit risk. An incorrect approach would be to immediately cease all coverage or demand immediate full payment of outstanding premiums without attempting to understand the cedent's situation or explore alternative solutions. This failure to engage in good faith negotiation violates the spirit of the reinsurance contract and could be seen as a breach of duty. Regulators would likely view such an action as imprudent risk management and potentially harmful to the stability of the insurance market. Another incorrect approach would be to ignore the situation and continue to provide coverage without addressing the premium arrears. This passive stance exposes the reinsurer to significant financial risk, potentially jeopardizing its own solvency and its ability to pay its own claims. It also fails to comply with regulatory requirements to manage financial risks effectively and maintain adequate capital. This inaction could lead to a situation where the reinsurer is unable to fulfill its obligations to other cedents or policyholders. A third incorrect approach would be to unilaterally terminate the contract without proper notice or adherence to the termination clauses stipulated in the reinsurance agreement. Such an action would likely be a breach of contract and could lead to legal challenges and regulatory sanctions. It demonstrates a lack of professionalism and a disregard for the contractual framework governing the relationship. The professional decision-making process for similar situations should involve a thorough assessment of the cedent's financial position, a review of the reinsurance contract's terms and conditions, particularly regarding premium payment and termination, consultation with legal and risk management departments, and open communication with the cedent to explore all viable options. The ultimate decision should prioritize maintaining the integrity of the reinsurance relationship where possible, while rigorously protecting the reinsurer's financial stability and regulatory compliance. Question 10. Cost-benefit analysis shows that establishing a branch in country X offers significant market growth potential and operational efficiencies for a UK-based reinsurer. However, country X has a distinct regulatory framework for reinsurance operations, including specific capital requirements and local asset holding mandates that differ from UK regulations. The reinsurer is considering two primary approaches to entering country X. Approach 1. Prioritize obtaining the necessary licenses and fully complying with all of country X's stipulated capital, solvency, and local asset holding regulations before commencing operations. Approach 2. Leverage the existing UK regulatory compliance framework and seek to operate under those standards, assuming they provide equivalent or greater protection, while minimizing upfront investment in understanding country X's specific rules. Which approach best aligns with the principles of cross-border reinsurance regulation and professional conduct for a UK-based reinsurer entering country X? Option A. Approach 2. As the UK's regulatory standards are generally considered robust and should be sufficient for operating in most foreign markets. Option B. Approach 1, but only if the cost of compliance with country X's regulations significantly outweighs the projected economic benefits. Option C. Approach 2, as it allows for faster market entry by utilizing established compliance procedures from the home jurisdiction. Option D. Approach 1, as it ensures adherence to the host country's specific regulatory framework, which is paramount for lawful operation and risk mitigation. The correct answer is D. Approach 1, as it ensures adherence to the host country's specific regulatory framework, which is paramount for lawful operation and risk mitigation. Explanation. This scenario is professionally challenging because it requires a reinsurer to navigate complex and potentially conflicting cross-border regulatory requirements when establishing a new branch in a foreign jurisdiction. The core challenge lies in balancing the economic benefits of market access and operational efficiency against the imperative of strict regulatory compliance. A failure to correctly interpret and apply the host country's specific reinsurance regulations could lead to significant penalties, reputational damage, and operational disruption. The correct approach involves a thorough and proactive engagement with the host country's regulatory authority to understand and implement all stipulated requirements for foreign reinsurers. This includes obtaining necessary licenses, adhering to solvency and capital adequacy rules, complying with reporting obligations, and respecting any local asset holding requirements. This approach is correct because it prioritizes adherence to the specific legal and regulatory framework of the jurisdiction where the reinsurer intends to operate, thereby ensuring lawful business conduct and mitigating regulatory risk. It demonstrates a commitment to operating within the established rules, which is a fundamental ethical and legal obligation for any financial institution. An incorrect approach that focuses solely on the economic benefits without adequately addressing regulatory prerequisites would be professionally unacceptable. This failure stems from a disregard for the host country's sovereign right to regulate its financial markets and protect its policyholders and the stability of its insurance sector. Such an approach risks operating illegally, leading to fines, license revocation, and potential civil litigation. Another incorrect approach that attempts to apply the home country's regulatory standards to the foreign branch would also be professionally unsound. This is because regulations are jurisdiction-specific and designed to address the unique risks and market conditions of that particular country. Applying home country rules would likely result in non-compliance with host country mandates, exposing the reinsurer to regulatory sanctions, and undermining the integrity of the host country's regulatory regime. A professional decision-making process for similar situations should begin with a comprehensive regulatory due diligence of the target jurisdiction. This should be followed by seeking expert legal and regulatory advice specific to that jurisdiction. The reinsurer must then develop a compliance plan that demonstrably meets all host country requirements before commencing operations. Continuous monitoring and adaptation to any changes in local regulations are also crucial. Question 11. Comparative studies suggest that the initial structuring of facultative reinsurance placements can be a critical juncture for both cedents and reinsurers. Considering the principles of reinsurance and the need for accurate risk assessment, which of the following approaches best reflects professional practice when a cedent seeks facultative cover for a portfolio of complex, high-value commercial property risks? Option A. Conduct a thorough review of the cedent's underwriting guidelines, historical loss experience for similar risks, and detailed information on the specific properties and their associated hazards to inform the facultative treaty structure. Option B. Focus on the speed of placement to meet the cedent's urgent need for coverage, deferring detailed risk analysis until after the treaty is bound. Option C. Prioritize the cedent's stated desired premium and coverage limits, assuming their internal underwriting has adequately assessed the risks. Option D. Immediately propose a standard facultative treaty form that has been used for similar portfolios in the past, with minimal customization. The correct answer is C. Prioritize the cedent's stated desired premium and coverage limits, assuming their internal underwriting has adequately assessed the risks. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires an underwriter to navigate the inherent complexities of reinsurance, specifically the initial steps of understanding and structuring a facultative reinsurance placement. The challenge lies in accurately assessing the cedent's needs and the underlying risks to propose a suitable facultative treaty, while also adhering to the principles of good faith and transparency expected in such transactions. Misinterpreting the cedent's objectives or the risk profile could lead to an inappropriate reinsurance structure, potentially leaving the cedent inadequately protected or the reinsurer exposed to unforeseen liabilities. The pressure to finalize a placement quickly can exacerbate this challenge, demanding a balance between speed and thorough due diligence. Correct approach analysis. The correct approach involves a comprehensive review of the cedent's underwriting guidelines, historical loss data, and the specific details of the underlying risks being presented for facultative reinsurance. This detailed examination allows the underwriter to understand the cedent's risk appetite, the types of risks they typically retain, and the rationale for seeking facultative cover. By engaging in a thorough due diligence process, the underwriter can then propose a facultative reinsurance treaty that accurately reflects the risk profile and provides appropriate coverage, aligning with the cedent's objectives and the reinsurer's capacity and expertise. This aligns with the fundamental principles of reinsurance, emphasizing mutual understanding and the accurate assessment of risk, which are implicitly expected under general insurance regulatory frameworks that promote sound business practices and fair dealing. Incorrect approaches analysis. An approach that focuses solely on the cedent's stated premium expectations without a deep dive into the underlying risks is professionally unacceptable. This failure to conduct adequate due diligence can lead to a mispricing of the risk and an inappropriate coverage structure, potentially exposing the reinsurer to losses it did not anticipate or adequately price for. This contravenes the principle of prudent underwriting and could be seen as a breach of good faith. Another incorrect approach is to assume that a standard facultative treaty form will suffice without considering the unique characteristics of the risks presented. This lack of customization ignores the specific exposures and can result in gaps in coverage or overinsurance, neither of which serves the best interests of either party and demonstrates a lack of professional diligence in tailoring reinsurance solutions. Finally, an approach that prioritizes speed of placement over the accuracy of risk assessment is also professionally flawed. While efficiency is valued, it should not come at the expense of thoroughness. Rushing the process without fully understanding the risks can lead to significant errors in judgment, potentially resulting in financial losses for the reinsurer and inadequate protection for the cedent. This demonstrates a disregard for the core principles of sound reinsurance practice, Professional reasoning. Professionals should adopt a systematic approach to facultative reinsurance placement. This involves 1. Understanding the cedent's business and risk appetite, thoroughly reviewing the cedent's underwriting philosophy, target markets, and historical performance. 2. Detailed risk assessment, analyzing the specific characteristics, exposures, and potential severity of the risks being offered for facultative cover. 3. Tailoring the reinsurance structure, designing a facultative treaty that precisely matches the identified risks and the cedent's needs, considering terms, conditions, and coverage limits. 4. Open communication and transparency, maintaining clear and honest dialogue with the cedent throughout the process. This structured approach ensures that reinsurance placements are based on sound risk evaluation and mutual understanding, upholding professional integrity and regulatory expectations for prudent insurance and reinsurance operations. Question 12. The monitoring system demonstrates that a cedent has consistently reported higher than average loss adjustment expenses, LE, for a particular line of business over the past 3 years, with a recent increase in the average settlement amount for claims within that same line. The reinsurer must decide how to address this situation to ensure compliance with regulatory principles and the reinsurance contract. Which of the following represents the most appropriate course of action? Option A. Inform the cedent that their LAE are too high and instruct them to reduce all claims settlement amounts by 10% to offset the increased expenses. Option B. Request a detailed breakdown of the cedent's LAE for the affected line of business, including supporting documentation for significant expenses, and initiate a review of the cedent's claims handling procedures and settlement authority levels for these types of claims. Option C. Immediately implement a strict cap on LAE for all future claims in that line of business to control costs and prevent further increases. Option D. Accept the reported LAE and settlement figures at face value, assuming the cedent is managing its claims efficiently and ethically. The correct answer is B. Request a detailed breakdown of the cedent's LAE for the affected line of business, including supporting documentation for significant expenses, and initiate a review of the cedent's claims handling procedures and settlement authority levels for these types of claims. Explanation. This scenario is professionally challenging because it requires the reinsurer to balance the need for efficient claims handling with its regulatory obligations to ensure fair and accurate loss adjustments. The pressure to reduce operational costs can create a conflict with the duty to thoroughly investigate and settle claims in accordance with the underlying policy terms and applicable regulations. Careful judgment is required to ensure that cost-saving measures do not compromise the integrity of the claims process or lead to unfair outcomes for the cedent. The correct approach involves the reinsurer actively engaging with the cedent's claims handling process, reviewing the cedent's loss adjustment expenses, LE, and settlement practices to ensure they are reasonable, documented, and compliant with the terms of the reinsurance contract and relevant regulatory guidelines. This proactive oversight, including a review of the cedent's internal controls and claims handling manuals, demonstrates adherence to the principle of good faith and the regulatory expectation that reinsurers will not passively accept claims handling that could be detrimental to the overall financial stability of the insurance market or lead to disputes. Specifically, regulatory frameworks often mandate that reinsurers have a vested interest in and a responsibility to oversee the claims handling of their cedents to prevent adverse selection and ensure solvency. This includes verifying that LAE are not excessive and that settlements are fair and in line with policy provisions. An incorrect approach would be to simply accept the cedent's reported LAE and settlement figures without independent verification, assuming they are accurate and reasonable. This passive stance fails to meet the regulatory expectation of oversight and could allow for inflated expenses or improper settlements to go unchecked, potentially impacting the reinsurer's own financial position and violating principles of prudent risk management. Another incorrect approach would be to impose arbitrary caps on LAE without a thorough review of the specific claims and the cedent's justification for those expenses. This could lead to the cedent being unable to adequately investigate or settle claims, potentially resulting in underpayments to policyholders or disputes, which would be a breach of the reinsurance contract and regulatory requirements for fair claims handling. A further incorrect approach would be to delegate the entire responsibility for LAE oversight to the cedent, without any independent review or audit by the reinsurer. While cedents are responsible for their own claims handling, reinsurers retain a responsibility to ensure that the costs incurred are appropriate and that the claims are settled in a manner consistent with the reinsurance agreement and regulatory standards. The professional decision-making process for similar situations should involve a risk-based approach to oversight. Reinsurers should establish clear guidelines for claims handling and LAE, conduct regular reviews and audits of cedent performance, and maintain open communication channels to address any concerns promptly. This ensures that both cost efficiency and regulatory compliance are maintained throughout the claims settlement process. Question 13. Investigation of a ceding insurer's accounting practices reveals that its finance department is considering booking significant reinsurance recoverables for a large portfolio of claims that have been ceded. The reinsurance contract is in place, and the reinsurer has verbally acknowledged receipt of the claim bordereau and indicated that payment is expected to be made. However, formal confirmation of the reinsurer's liability and the exact amount payable has not yet been received, and the bordereau has not been fully processed by the reinsurer for validation. The finance department is under pressure to demonstrate strong financial performance for the current reporting period. What is the most appropriate course of action for the ceding insurer regarding the recognition of these reinsurance recoverables? Option A. Delay the recognition of the reinsurance recoverables until formal confirmation of the reinsurer's liability and the exact amount payable is received, and the bordereau has been fully validated by the reinsurer. Option B. Book the reinsurance recoverables at an estimated amount based on historical data, assuming the reinsurer will agree to the estimate. Option C. Recognize the reinsurance recoverables based on the verbal acknowledgement and the expectation of payment, as this will improve the current period's financial results. Option D. Recognize a portion of the reinsurance recoverables based on the claims that have been verbally confirmed by the reinsurer, even if the total amount is not yet finalized. The correct answer is C. Recognize the reinsurance recoverables based on the verbal acknowledgement and the expectation of payment, as this will improve the current period's financial results. Explanation. This scenario presents a professional challenge because it involves a potential conflict between a reinsurer's desire to recover funds and the ethical obligation to accurately represent the financial position of the ceding company. The core of the dilemma lies in the timing of recognizing reinsurance recoverables and the potential for misrepresenting the ceding company's solvency or financial health if these recoverables are prematurely booked. The principles of reinsurance, particularly concerning the recognition of recoverables, are heavily influenced by regulatory frameworks designed to ensure financial stability and transparency. The correct approach involves adhering strictly to the established accounting principles and regulatory guidelines for recognizing reinsurance recoverables. This means that recoverables should only be recognized when there is reasonable assurance that the reinsurer will be able to meet its obligations and when the recoverables are both measurable and collectible. This aligns with the overarching regulatory objective of preventing the misstatement of financial statements and ensuring that stakeholders have a true and fair view of the company's financial position. Specifically, under the regulatory framework for this exam, the recognition of reinsurance recoverables is governed by principles that emphasize certainty and measurability, preventing the premature booking of assets that may not materialize. This approach upholds the integrity of financial reporting and protects policyholders and other stakeholders. An incorrect approach would be to prematurely recognize reinsurance recoverables based on a verbal agreement or an expectation of payment, without sufficient documentation or confirmation from the reinsurer. This fails to meet the regulatory requirement for certainty and measurability, potentially leading to an overstatement of assets and an understatement of liabilities on the ceding company's balance sheet. Such an action could mislead regulators, investors, and rating agencies about the company's financial health, potentially triggering regulatory scrutiny or even enforcement actions. Another incorrect approach would be to delay the recognition of legitimate reinsurance recoverables due to internal pressures or a desire to manage reported earnings. This also violates regulatory principles by misrepresenting the company's financial position, albeit in the opposite direction. Failing to book assets that are rightfully due can lead to an understatement of profitability and net worth, which can be equally damaging to stakeholder confidence and regulatory compliance. The professional decision-making process in such situations should involve a thorough review of all relevant documentation, including reinsurance contracts, bordereau, and correspondence with the reinsurer. It requires consulting with internal accounting and legal departments, and if necessary, seeking external expert advice to ensure compliance with all applicable accounting standards and regulatory requirements. The paramount consideration must always be the accurate and transparent representation of the company's financial position, adhering to the spirit and letter of the regulatory framework. Question 14. Process analysis reveals that a client is seeking reinsurance protection for their property portfolio. They have expressed concern about both the accumulation of smaller, frequent claims and the potential impact of a single, large-scale natural disaster. The client's broker is considering recommending a combination of reinsurance structures. Which of the following explanations most accurately differentiates the protective functions of working cover, catastrophe cover, and aggregate excess of loss in addressing these client concerns? Option A. Working cover is designed to cover individual large claims. Catastrophe cover protects against the accumulation of small, everyday claims, and aggregate excess of loss is primarily for smoothing out volatility from frequent, smaller losses. Option B. Working cover protects against the accumulation of smaller, more frequent losses. Catastrophe cover is triggered by large, infrequent events causing significant aggregate losses. An aggregate excess of loss protects against the accumulation of losses over a period exceeding a specified aggregate amount. Option C. Working cover is triggered by a single, massive event. Catastrophe cover protects against the accumulation of small, everyday claims. An aggregate excess of loss is designed to cover individual large claims. Option D. Working cover is primarily for smoothing out volatility from frequent, smaller losses. Catastrophe cover is designed to cover individual large claims. An aggregate excess of loss protects against the accumulation of small, everyday claims. The correct answer is B. Working cover protects against the accumulation of smaller, more frequent losses. Catastrophe cover is triggered by large, infrequent events causing significant aggregate losses. An aggregate excess of loss protects against the accumulation of losses over a period exceeding a specified aggregate amount. Explanation. This scenario presents a professional challenge because it requires the reinsurance broker to accurately assess and communicate the distinct risk transfer mechanisms of different excess of loss covers to a client. Misunderstanding or misrepresenting these covers can lead to significant financial miscalculations for the cedent and potentially expose the broker to liability. The client's reliance on the broker's expertise necessitates a thorough understanding of how working cover, catastrophe cover, and aggregate excess of loss operate in practice, particularly concerning their triggers, limits, and the nature of the losses they address. Correct approach involves clearly distinguishing between the types of excess of loss covers and their intended purposes. Working cover is designed to protect against the accumulation of smaller, more frequent losses within a defined period, effectively smoothing out volatility. Catastrophe cover, conversely, is triggered by large, infrequent events that cause significant aggregate losses exceeding a high retention, providing protection against tail risk. Aggregate excess of loss, also dealing with accumulations, typically operates over a longer period, often an annual basis, and protects against an accumulation of losses that exceed a specified aggregate amount, regardless of the size of individual claims, up to a defined limit. A professional broker must articulate these differences, ensuring the client understands which cover addresses which risk profile and how they might interact or provide distinct layers of protection. This aligns with the regulatory expectation for brokers to act with due skill, care, and diligence, providing advice that is suitable for the client's needs and clearly explaining the products being offered. An incorrect approach would be to conflate working cover with catastrophe cover, suggesting that a working cover policy would provide protection against a single, massive hurricane event. This fails to recognize that working cover is typically designed for smaller, more frequent losses and would likely not be triggered by a single, large-scale catastrophe. This misrepresentation would lead the client to believe they have protection they do not, violating the duty of care. Another incorrect approach would be to describe aggregate excess of loss as solely protecting against individual large claims. While it does protect against large losses, its primary function is to protect against the accumulation of losses over a period exceeding a certain threshold. Failing to emphasize the aggregate nature of this cover would mislead the client about the scope of protection. A further incorrect approach would be to suggest that catastrophe cover is designed to protect against the accumulation of small, everyday claims. This misunderstands the fundamental purpose of catastrophe cover, which is to address infrequent, high-severity events. Presenting it as a solution for frequent, low-severity losses would be a significant misstatement of its function and a failure to provide accurate advice. Professional decision-making in such situations requires a structured approach. First, the broker must thoroughly understand the client's risk appetite and the specific risks they face. Second, the broker must possess a deep and accurate understanding of the various reinsurance products available, including their triggers, limits, and the types of losses they are designed to cover. Third, the broker must be able to clearly and concisely communicate these complex concepts to the client, ensuring comprehension. This involves tailoring the explanation to the client's level of understanding and avoiding jargon where possible. Finally, the broker must document all advice and discussions, providing a clear audit trail of the decision-making process and the rationale behind the recommended reinsurance structure. Question 15. The risk matrix shows a potential increase in the frequency and severity of natural catastrophe claims for a cedent operating in a high-risk geographical area. The cedent's reported solvency ratio remains within regulatory minimums. The reinsurer is considering renewing the treaty. Which approach best aligns with the principles of reinsurer solvency and financial strength assessment? Option A. Focus on the cedent's strong historical profitability in other lines of business, assuming this will offset potential catastrophe losses. Option B. Conduct a deep dive into the cedent's underwriting guidelines for catastrophe-exposed business, review their catastrophe modeling capabilities, and assess the adequacy of their reinsurance protection for such events. Option C. Accept the cedent's solvency ratio as sufficient, given it meets the regulatory minimum, and proceed with the renewal. Option D. Rely on the cedent's established market reputation and long-standing relationship as indicators of their financial stability. Correct answer is B. Conduct a deep dive into the cedent's underwriting guidelines for catastrophe-exposed business, review their catastrophe modeling capabilities, and assess the adequacy of their reinsurance protection for such events. Explanation. This scenario is professionally challenging because it requires the reinsurer to move beyond a superficial review of a cedent's financial statements and engage in a proactive, forward-looking assessment of solvency. The temptation might be to rely solely on reported figures, which can be misleading or fail to capture emerging risks. Careful judgment is required to interpret the nuances of the cedent's business and its potential impact on the reinsurer's own financial strength. The correct approach involves a comprehensive assessment of the cedent's underwriting strategy, claims handling practices, and overall risk management framework. This goes beyond simply looking at capital adequacy ratios. It requires understanding the quality of the cedent's assets, the adequacy of its reserves, and the effectiveness of its internal controls. Regulatory frameworks, such as those governing solvency and financial strength in the reinsurance industry, mandate that reinsurers conduct thorough due diligence to ensure that their counterparties are financially sound and capable of meeting their obligations. This proactive risk assessment is crucial for maintaining the reinsurer's own solvency and protecting policyholders and stakeholders. An incorrect approach that relies solely on the cedent's reported capital adequacy ratios fails to acknowledge that these ratios can be influenced by accounting policies and may not reflect the true underlying risk profile of the business. This approach is ethically questionable, as it prioritizes a superficial compliance check over a substantive assessment of financial health, potentially exposing the reinsurer to undue risk. Another incorrect approach that focuses only on the cedent's historical profitability without considering future trends or potential adverse developments ignores the forward-looking nature of solvency assessment. Reinsurance is about future risk transfer, and past performance is not a guarantee of future results. This approach is regulatory non-compliant, as it neglects the requirement to assess the cedent's ability to withstand future shocks. A third incorrect approach that prioritizes the cedent's market reputation over a detailed financial and operational review is also professionally unsound. While reputation is important, it does not substitute for a rigorous evaluation of financial strength and risk management capabilities. This approach risks regulatory censure for failing to perform adequate due diligence. Professionals should adopt a decision-making framework that begins with understanding the specific regulatory requirements for solvency assessment in their jurisdiction. This involves identifying key risk indicators, both quantitative and qualitative, and developing a systematic process for evaluating them. The process should be iterative, involving ongoing monitoring and reassessment as circumstances change. It requires a blend of financial analysis, operational review, and an understanding of the cedent's business strategy and the economic environment in which it operates. Question 16. The review process indicates that a reinsurer is evaluating several catastrophe modeling techniques for assessing their exposure to a new portfolio of property risks in a region prone to both earthquake and hurricane events. Which of the following approaches best demonstrates adherence to sound reinsurance principles and practices in this context? A. Selecting the catastrophe model that has the most advanced algorithms and the highest reported accuracy statistics from the vendor, without further independent validation of its suitability for the specific portfolio's characteristics. B. Utilizing a suite of catastrophe models that have been independently vetted for their underlying methodologies, data inputs, and ability to accurately represent the specific perils, earthquake and hurricane, and geographic nuances of the new portfolio, with a clear understanding of each model's limitations. C. Adopting a single, widely used catastrophe model that has historically provided satisfactory results for other lines of business, assuming it will be equally effective for this new and distinct risk profile. D. Prioritizing the catastrophe model that generates the lowest estimated insured losses for the portfolio, as this will optimize the reinsurer's pricing and capital requirements. Option A. Selecting the catastrophe model that has the most advanced algorithms and the highest reported accuracy statistics from the vendor, without further independent validation of its suitability for the specific portfolio's characteristics. Option B. Utilizing a suite of catastrophe models that have been independently vetted for their underlying methodologies, data inputs, and ability to accurately represent the specific perils, earthquake and hurricane, and geographic nuances of the new portfolio, with a clear understanding of each model's limitations. Option C. Prioritizing the catastrophe model that generates the lowest estimated insured losses for the portfolio, as this will optimize the reinsurer's pricing and capital requirements. Option D. Adopting a single, widely used catastrophe model that has historically provided satisfactory results for other lines of business, assuming it will be equally effective for this new and distinct risk profile. The correct answer is B. Utilizing a suite of catastrophe models that have been independently vetted for their underlying methodologies, data inputs, and ability to accurately represent the specific perils, earthquake and hurricane, and geographic nuances of the new portfolio, with a clear understanding of each model's limitations. Explanation. The review process indicates a need to evaluate the application of catastrophe modeling techniques within the context of reinsurance. This scenario is professionally challenging because the selection and interpretation of catastrophe models directly impact the accuracy of risk assessment, pricing, and capital allocation for reinsurers. Misapplication or misunderstanding of these models can lead to significant financial misstatements, inadequate reserving, and ultimately, regulatory noncompliance and reputational damage. The core challenge lies in ensuring that the chosen modeling approach aligns with the specific risks being underwritten, and that the outputs are understood and applied appropriately, rather than being treated as infallible predictions. The correct approach involves a comprehensive evaluation of catastrophe models based on their underlying methodologies, data inputs, and validation processes, ensuring they are fit for purpose for the specific perils and geographies being reinsured. This aligns with the principles of prudent risk management and sound financial reporting, expected under regulatory frameworks that emphasize the importance of robust actuarial and risk assessment practices. Specifically, regulatory guidance often requires that models used for financial reporting and capital adequacy assessments are demonstrably sound, well-documented, and subject to independent review. The chosen approach must also consider the limitations of the models and the inherent uncertainties in catastrophe modeling, ensuring that outputs are used as inputs to a broader decision-making process, not as definitive answers. An incorrect approach would be to solely rely on the vendor's claims about a model's sophistication without independent verification of its suitability for the specific portfolio. This fails to meet the professional obligation to conduct due diligence and ensure that the tools used are appropriate for the task. Regulatory frameworks typically require that entities understand the tools they employ and can justify their use, especially when those tools inform financial decisions. Another incorrect approach is to prioritize models that produce the most favorable financial outcomes for the reinsurer, irrespective of their scientific rigor or alignment with the actual risk profile. This constitutes a failure of professional integrity and can lead to misrepresentation of risk, violating ethical standards and potentially breaching regulatory requirements related to fair dealing and accurate financial reporting. A further incorrect approach is to use a one-size-fits-all catastrophe model across diverse lines of business and geographies without considering the unique characteristics of each. This demonstrates a lack of understanding of the nuances of catastrophe risk and the limitations of generalized models, leading to potentially inaccurate risk assessments and pricing. Regulatory bodies expect a tailored approach to risk management, reflecting the specific exposures of the entity. The professional decision-making process for similar situations should involve a structured evaluation of catastrophe modeling options. This includes understanding the specific risks to be modeled, perils, geographies, policy terms, researching available modeling techniques and vendors, critically assessing the methodologies, data sources, assumption, and validation of each model, considering the model's limitations and the uncertainty inherent in its outputs, and ensuring that the chosen model, S, are used in conjunction with expert judgment and other risk management tools to inform strategic decisions. Transparency in model selection and application, along with robust documentation, is also crucial for demonstrating compliance and sound practice. Question 17. Risk assessment procedures indicate a potential dispute arising from a reinsurance contract where the cedent has settled a claim under an original policy. The reinsurance contract includes a follow the fortunes clause. The reinsurer is questioning whether the claim settlement by the cedent fully aligns with the terms of the original policy, and whether the follow the fortunes clause in the reinsurance contract is absolute or subject to specific conditions. Which of the following approaches best addresses the legal considerations in this contract wording scenario under UK regulatory principles? Option A. The reinsurer should rely on the cedent's assertion that the claim was settled in good faith and pay the claim without further investigation, as the cedent is presumed to act in the best interests of all parties. Option B. The reinsurer should seek an opinion from a general industry body on the typical interpretation of follow the fortunes clauses and base its decision on that opinion. Option C. The reinsurer should automatically accept the cedent settlement based on the follow the fortunes clause, as this is standard industry practice for such clauses. Option D. The reinsurer should conduct a detailed review of the reinsurance contract's wording, specifically examining the follow the fortunes clause for any limitations, exclusions, or conditions, and compare this with the terms of the original policy and the settled claim. The correct answer is C. The reinsurer should automatically accept the cedent settlement based on the follow the fortunes clause, as this is standard industry practice for such clauses. Explanation. This scenario is professionally challenging because it requires a reinsurer to navigate the complexities of contract wording in a cross-border context, specifically concerning the interpretation of a follow the fortunes clause. The core difficulty lies in ensuring that the reinsurer's obligations are clearly defined and align with the original insurer's liabilities, while also adhering to the specific regulatory framework governing reinsurance contracts in the relevant jurisdiction. Misinterpretation or ambiguity in contract wording can lead to significant financial disputes and regulatory breaches. The correct approach involves a meticulous review of the reinsurance contract's wording, with a specific focus on how the follow the fortunes clause is defined and any limitations or exclusions it contains. This approach is correct because it directly addresses the legal interpretation of the contract, which is paramount in reinsurance. Regulatory frameworks, such as those governing insurance and reinsurance in the UK e.g. the Financial Conduct Authorities, FCA Handbook, and relevant case law like the Financial Services and Markets Act 2000, emphasize the importance of clear and unambiguous contract terms. A follow the fortunes clause, while common, is not absolute and can be qualified by other provisions in the contract. Therefore, understanding the precise scope of this clause as intended by both parties and as interpreted under the governing law, is essential to avoid disputes and ensure compliance with solvency and conduct of business rules. This involves considering whether the original loss was within the scope of the original policy and whether the reinsurer's liability is truly automatic or subject to specific conditions. An incorrect approach would be to assume that follow the fortunes automatically means the reinsurer must pay any claim settled by the cedent, regardless of the circumstances. This fails to acknowledge that the clause is often subject to implied or express conditions, such as the loss being within the terms of the original policy and the cedent acting in good faith. This assumption can lead to the reinsurer being held liable for claims that were not genuinely covered by the original policy or were settled improperly, potentially violating principles of indemnity and good faith, and contravening regulatory expectations for prudent risk management and financial soundness. Another incorrect approach would be to rely solely on industry custom or practice without a thorough examination of the specific contract wording. While industry norms can provide context, they do not override the explicit terms of a legally binding contract. Regulatory bodies expect reinsurers to operate based on contractual agreements, not on unwritten understandings that may not be legally enforceable or may be interpreted differently by various parties. This can lead to disputes over coverage and potential regulatory scrutiny for failing to adhere to contractual obligations. A third incorrect approach would be to prioritize the cedent's immediate request for payment without conducting due diligence on the underlying claim and the original policy. This bypasses the reinsurer's responsibility to assess the validity of the claim and its coverage under the original policy, which is a fundamental aspect of reinsurance underwriting and risk management. Regulatory frameworks often require insurers and reinsurers to have robust claims handling and oversight processes to protect policyholders and maintain financial stability. The professional decision-making process for similar situations should involve a structured approach. First, thoroughly understand the specific terms and conditions of the reinsurance contract, paying close attention to any clauses that modify or qualify standard provisions like follow the fortunes. Second, assess the underlying claim and the original policy to determine if the loss falls within the scope of coverage as defined by the original policy and the reinsurance contract. Third, consider the governing law and any relevant regulatory guidance or case law that might influence the interpretation of the contract. Finally, engage in clear and transparent communication with the cedent regarding any concerns or questions about the claim and the interpretation of the contract. Question 18. Assessment of the impact of a proposed surplus share reinsurance treaty on an insurer's underwriting capacity and the reinsurer's exposure requires careful consideration of several factors. Which of the following approaches best reflects a prudent and compliant method for evaluating such a treaty? Option A. Relying on historical performance data of similar surplus share treaties in the market to determine the acceptable level of risk and premium, without specific analysis of the current ceding company's operations. Option B. Focusing primarily on the administrative ease of processing multiple small participations ceded under the treaty, without a deep dive into the underlying risk quality or the ceding company's retention strategy. Option C. Conducting a comprehensive review of the ceding company's underwriting guidelines, assessing the appropriateness of its proposed line guide in relation to its financial strength and risk appetite, and evaluating the reinsurer's own capacity and appetite for the specific class of business being reinsured. Option D. Prioritizing the potential for increased premium income and accepting the ceding company's proposed line guide without extensive due diligence, assuming the surplus nature of the treaty inherently benefits the reinsurer. The correct answer is D. Prioritizing the potential for increased premium income and accepting the ceding company's proposed line guide without extensive due diligence, assuming the surplus nature of the treaty inherently benefits the reinsurer. Explanation. This scenario presents a professional challenge because it requires a reinsurer to accurately assess the impact of a surplus share treaty on its underwriting capacity and financial exposure, while also considering the potential benefits and drawbacks of such an arrangement. The core of the challenge lies in understanding how surplus share, by its nature, allows the ceding company to retain a larger portion of its gross premium while transferring the excess risk, thereby increasing its underwriting capacity. A reinsurer must diligently evaluate the ceding company's risk appetite, the quality of its underwriting, and the potential for adverse selection. The decision to participate in a surplus share treaty, and on what terms, necessitates a deep understanding of the mechanics of the treaty, the concept of line guides, and the overall capacity being offered. The correct approach involves a thorough assessment of the ceding company's proposed line guide. This guide dictates the maximum amount of risk the ceding company will retain on any single risk before ceding it under the surplus share treaty. A well-defined and appropriate line guide is crucial for managing the reinsurer's exposure. The reinsurer must verify that the ceding company's retention, its line, is prudent and aligns with its financial strength and underwriting expertise. The reinsurer's own capacity must also be considered, ensuring that the aggregate of risks ceded under the surplus share treaty does not exceed its appetite for that class of business. This approach is professionally sound because it directly addresses the fundamental principles of risk transfer and capacity management inherent in surplus share reinsurance. It ensures that the reinsurer is not inadvertently taking on more risk than it can prudently handle or than is justified by the premium received, aligning with the regulatory expectation of prudent risk management and solvency. An incorrect approach would be to accept the ceding company's proposed line guide without independent verification or a thorough understanding of the underlying risks. This failure to scrutinize the line guide is a significant regulatory and ethical lapse. It demonstrates a lack of due diligence and a disregard for the reinsurer's own risk management responsibilities. Such an oversight could lead to the reinsurer accepting a disproportionate share of poorly underwritten or excessively large risks, potentially jeopardizing its financial stability and solvency, which is a direct contravention of regulatory requirements for sound financial management. Another incorrect approach is to focus solely on the potential for premium income from the surplus share treaty, without adequately assessing the associated risk. While premium is important, it is secondary to the prudent management of risk. Overlooking the potential disadvantages, such as the administrative burden of managing multiple small participations or the risk of adverse selection if the ceding company is offloading its worst risks, is a failure to conduct a comprehensive impact assessment. This can lead to unexpected losses and a deviation from the reinsurer's strategic objectives, potentially exposing it to regulatory scrutiny for inadequate risk assessment and control. A third incorrect approach is to assume that because the treaty is surplus share, it automatically implies a benefit to the reinsurer without understanding the specific terms and the ceding company's operational capabilities. Each surplus share treaty is unique, and its success depends on the interplay of the ceding company's underwriting, the reinsurer's capacity, and the agreed-upon terms. Failing to conduct a bespoke analysis for each treaty, relying instead on generalized assumptions, is a critical professional failing. This can lead to mispricing of risk and an imbalance in the risk-reward equation, which is contrary to the principles of sound insurance and reinsurance practice and can attract regulatory attention for imprudent business conduct. The professional decision-making process for similar situations should involve a structured approach. First, understand the specific type of reinsurance treaty and its mechanics. Second, meticulously analyze the ceding company's proposal, including its underwriting philosophy, risk appetite, and proposed retention levels, line guide. Third, assess the reinsurer's own capacity and appetite for the specific class of business. Fourth, evaluate the potential advantages and disadvantages of the proposed arrangement, considering both financial and operational aspects. And finally, ensure that all decisions are documented and justifiable from a risk management and regulatory compliance perspective. Question 19. Upon reviewing a facultative reinsurance certificate for a complex property risk, a dispute arises regarding the interpretation of the phrase, "all reasonable steps to mitigate loss," within the claims control clause. The cedent has incurred significant expenses in implementing preventative measures following a partial loss event, arguing these were all reasonable steps. The reinsurer contends these measures exceeded what was reasonably necessary and were not directly attributable to mitigating the specific loss covered by the certificate. What is the most appropriate approach to resolving this interpretation dispute, adhering strictly to the principles and practices governing reinsurance in the specified jurisdiction? Option A. Interpret the phrase by prioritizing the cedent's interpretation, as they are closer to the operational realities of the risk and the immediate post-loss environment. Option B. Interpret the phrase by examining the entire reinsurance certificate, including any endorsements, schedules, and related correspondence, to understand the parties' mutual intent and consider relevant industry custom and practice for claims control clauses in similar facultative placements. Option C. Interpret the phrase based on a strict, literal dictionary definition of reasonable and mitigate, without considering the broader context of the reinsurance contract or industry practices. Option D. Interpret the phrase by focusing solely on the financial impact of the measures taken, deeming them unreasonable if the cost of the measures significantly outweighs the estimated loss prevented. The correct answer is B. Interpret the phrase by examining the entire reinsurance certificate, including any endorsements, schedules, and related correspondence, to understand the parties' mutual intent, and consider relevant industry custom and practice for claims control clauses in similar facultative placements. Explanation: this scenario is professionally challenging because it involves interpreting an ambiguous clause within a reinsurance contract, directly impacting the financial obligations and risk allocation between the cedent and the reinsurer. The absence of clear contractual language necessitates a careful and principled approach to avoid disputes and ensure fair treatment, aligning with the principles of good faith and utmost good faith inherent in reinsurance relationships. The correct approach involves a thorough review of the entire reinsurance contract, including any related correspondence, industry custom and practice, and relevant legal precedents within the specified jurisdiction. This holistic interpretation aims to ascertain the mutual intention of the parties at the time the contract was entered into. This aligns with the regulatory framework's emphasis on contractual certainty and the equitable resolution of disputes, promoting the stability and integrity of the reinsurance market. The principle of interpreting contracts to give effect to the parties' presumed intentions, rather than strictly adhering to literal but potentially misleading wording, is paramount. An incorrect approach would be to unilaterally interpret the ambiguous clause in a manner that solely benefits one party, without considering the other party's perspective or the broader context of the agreement. This could lead to a breach of the duty of utmost good faith, a cornerstone of reinsurance law and practice, which requires transparency and honesty in all dealings. Another incorrect approach would be to ignore established industry custom and practice when interpreting the clause. Reinsurance contracts are often heavily influenced by these norms, and their disregard can lead to an interpretation that is commercially unreasonable and contrary to the parties' likely expectations. Finally, relying solely on a dictionary definition of the ambiguous term, divorced from the contractual context and industry understanding, would be an insufficient and potentially misleading method of interpretation, failing to capture the nuanced meaning intended by the parties. Professionals should adopt a decision-making framework that prioritizes understanding the parties' intent through comprehensive contract review, consideration of industry norms, and adherence to legal principles of contract interpretation. When ambiguity arises, open communication and negotiation with the counterparty should be pursued before resorting to formal dispute resolution. Question 20. System analysis indicates a reinsurer has been presented with a significant volume of new business opportunities that promise attractive short-term returns. However, the underwriting team has identified that accepting all of this business would push the reinsurer close to its defined risk appetite limits and potentially strain its capital reserves if a series of moderate to large losses were to occur concurrently. The reinsurer's management is considering how to respond to these opportunities, balancing the desire for growth with the imperative of maintaining financial stability and fulfilling its role as a reliable capacity provider. Which of the following approaches best aligns with the principles of reinsurance capacity, stability, and expertise in this context? Option A. Conduct a comprehensive risk assessment, including stress testing and scenario analysis, to determine the maximum sustainable level of new business that aligns with capital adequacy, risk appetite, and solvency requirements, and then selectively accept business up to that limit, potentially using retrocession to manage residual risk. Option B. Accept the new business but significantly reduce pricing across the board to ensure it is fully absorbed by the market, even if it means accepting lower profit margins. Option C. Aggressively accept all new business to maximize short-term profits and market share, assuming future profitability will replenish capital. Option D. Reject all new business opportunities due to the proximity to risk appetite limits, prioritizing absolute capital preservation over potential growth. The correct answer is C. Aggressively accept all new business to maximize short-term profits and market share, assuming future profitability will replenish capital. Explanation: scenario analysis. This scenario presents a challenge for a reinsurer in managing its capacity and ensuring stability while also leveraging its expertise. The core difficulty lies in balancing the desire to expand market share and profitability with the inherent risks of taking on too much business, potentially exceeding its financial capacity, and compromising its ability to absorb losses. The reinsurer must make a strategic decision that aligns with its risk appetite, capital adequacy, and long-term solvency, all while adhering to regulatory expectations regarding prudent risk management and the provision of adequate capacity to cedents. Correct approach analysis. The correct approach involves a thorough assessment of the reinsurer's current capital position, its risk appetite, and the potential impact of the new business on its solvency ratios and overall financial stability. This includes stress testing its portfolio under various adverse scenarios to understand its capacity to absorb potential large losses. The reinsurer should then determine a sustainable level of new business that aligns with its strategic objectives and regulatory requirements for capital adequacy. This approach prioritizes financial prudence and long-term viability, ensuring the reinsurer can fulfill its obligations to cedents and maintain market confidence. Regulatory frameworks, such as those governing solvency and capital requirements, e.g., Solvency Roman II in relevant jurisdictions, mandate that insurers and reinsurers operate within their financial means and maintain sufficient capital to cover their risks. Incorrect approaches analysis. One incorrect approach would be to aggressively pursue the new business solely based on projected short-term profitability, without a commensurate assessment of the reinsurer's capacity and the potential strain on its capital. This could lead to overexposure to risk, jeopardizing solvency, and potentially violating regulatory requirements for capital adequacy. It fails to acknowledge the function of reinsurance in providing stability and managing risk within prudent limits. Another incorrect approach would be to reject the new business outright due to a conservative interpretation of capacity, even if the reinsurer has the financial strength and expertise to underwrite it profitably and within acceptable risk parameters. This approach fails to leverage the expertise function of reinsurance, which involves sharing knowledge and underwriting capabilities, and could lead to missed opportunities for growth and diversification, potentially impacting long-term competitiveness. A third incorrect approach would be to accept the new business, but to underprice it significantly to attract volume, thereby compromising profitability and potentially creating a false sense of capacity. This strategy undermines the stability function of reinsurance by creating a business that is not financially sustainable, and it misuses the expertise function by not reflecting the true risk in the pricing. Professional reasoning. Professionals should approach such decisions by first understanding the reinsurer's strategic goals and risk appetite. This should be followed by a robust quantitative and qualitative assessment of the proposed business, considering its impact on capital, solvency, and the reinsurer's ability to absorb potential losses. Regulatory requirements for capital adequacy and prudent risk management must be paramount. Decision-making should involve a cross-functional team, including underwriting, finance, and risk management, to ensure a holistic view. The ultimate decision should be based on a sustainable balance between growth, profitability, and the preservation of financial strength and stability, thereby fulfilling the core functions of reinsurance.